Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now let's get into the numbers.
Right, so today we're zeroing in on Lanka Aluminium Industries PLC, ticker LALU. We've got the H1 2025 financial data in front of us.
And our goal here, as always, isn't just to skim the summary. We're looking past the official story.
Exactly. We want to bypass the accrual accounting headlines and really excavate what we call the true P&L, the operational reality that's often buried a few layers deep.
And LALU's first half results for 2025, they serve up one of the most glaring contradictions we've seen this quarter. It's really something. We have to start right there.
With the biggest anomaly, for sure.
The cash flow paradox. I mean, look, if you were a casual investor, you'd glance at the bottom line and probably just move on. It looks stable, almost boring.
Completely flat.
Net profit attributable to the parent company was 140 million rupees. Last year, it was 139.3 million. It's a rounding error. So stability, right?
And that stability is the illusion. It's the thing we have to just cut right through. Because the second you shift your eyes from the P&L over to the cash flow statement, well, that whole picture of stability just evaporates.
It completely vanishes. The company's core operations, I mean, they didn't just generate a little bit of cash.
They didn't generate any. Operating cash flow, or OCF, was actually negative. Negative 8.9 million rupees.
Let that sink in. Negative 8.9 million. This is, by definition, a bright red flag. You're telling the market you've made 140 million in profit, but you failed to generate a single real rupee from your core business.
The business of, melting aluminum, making products, selling them, and collecting the cash. All that activity ended up burning cash.
So this divergence, it immediately puts the quality of every single rupee of that reported profit under a massive microscope.
Precisely. And this isn't just some small fluctuation, a minor timing difference. This points to a structural breakdown in the cash conversion cycle. We can actually quantify that breakdown.
With the cash conversion ratio.
Exactly. And if we compare that negative operational cash flow to the net profit, we get a ratio of, it's a devastating negative 5.5%.
Okay, let's just pause on the severity of that number for a moment because it really is the foundation for this entire deep dive. Last year, LALU was a solid cash generator.
They were.
They were probably converting, maybe 80 cents or more of every rupee of profit into actual cash in the bank. And now for every rupee of profit they report, they're actually losing 5.5 cents in cash from operations.
The reversal is just staggering. It fundamentally means the company isn't liquidating its production cycle. They are making the goods, they are recording the sale, they're booking the profit on paper.
But the cash is stuck. It's trapped.
It's either stuck with their customers, as receivables, or it's piled up high in a warehouse as inventory. Whenever you see a positive P&L and a negative cash flow, you know the answer lies in working capital.
And that's exactly where we need to start digging. If the cash conversion is broken, we have to figure out what happened upstream. So let's move to our first section, the operational health check.
Yeah.
If the bottom line profit was flat, despite this cash crisis, where did the pressure actually blow up? You have to start with sales, the top line.
And again, on the surface, the revenue number looks respectable. It's a 5% year-over-year increase, hitting about 1,759 million rupees.
In this market for construction and industrial goods, 5% growth, management could easily spin that as a win.
They could. But the moment you look one line below revenue on the P&L, that illusion just shatters.
Because right there you have the cost of sales, and that tells a completely different and much darker story about the environment they're in.
It really does. So revenue goes up by 5%. Okay. But the cost of sales, it surged by 7.6%.
There it is. That's the first critical imbalance.
Your main costs are growing more than 50% faster than your sales. That immediately suggests LALU is facing some serious input cost inflation.
Could be anything, right? Global aluminum prices, soaring energy costs for their plants, imported components.
Whatever it is, they are clearly struggling to either absorb it or, more importantly, pass those costs on to their customers.
And that mismatch, that 7.6% versus 5%, it mathematically guarantees one thing.
The gross margin squeeze.
Exactly. Walk us through the numerical damage that did to their core manufacturing profitability.
Well, the gross profit itself took a direct hit. It fell by 3.3%, down to about 390 million. But the metric we really watch is the gross margin, the percentage of revenue they keep after paying for what they sold.
And that's where the real story is.
It dropped substantially.
Yeah.
It went from 24.1% in the same period last year all the way down to 22.2% this year.
So that's a compression of 191 basis points.
Huge drop.
Okay, so let's dig into what that 191 basis point contraction really means. This is where we have to challenge the narrative. If LALU is a big player in its market, why couldn't it just pass that 7.6% cost increase on to?
That's the classic question, isn't it? The standard interpretation is a failure of pricing power.
Right. They're caught in a vice, their suppliers are charging more, but their customers won't pay more because of competition. So LALU has to eat the difference.
That's the most likely scenario. But let's play devil's advocate for a second.
Mm-hmm.
Could this be in some small way strategic?
What do you mean?
I mean, could they be deliberately holding prices a bit lower, maybe only passing on half the cost increase to try and gain some market share or push more volume, betting they can make it up later?
That's a fair point to consider, but if that were the case, if they were sacrificing margin for volume, you'd expect to see revenue growth much, much higher than just 5%.
True. 5% doesn't exactly scream successful market share grab.
So the narrative of forced cost absorption due to weak pricing power just seems much more credible here. And 22% gross margin. That is getting dangerously thin for a capital-intensive manufacturing business.
It is. Gross margin is your first line of defense, and when it erodes by nearly 2 full percentage points in just 6 months, it tells you the core business model is under some pretty severe strain.
And it didn't stop there. As if the gross margin pressure wasn't enough, we then see a second layer of trouble.
The operating expense creep.
The company had already taken a hit on its core profitability, and then it seems they went on a spending spree.
This is what you'd call, inefficient management, especially when your top-line growth is so weak. We saw administrative expenses jump by 18%.
80%.
And marketing. Marketing costs rose 10%. Now, just remind yourself again, revenue grew 5%. When your core overheads are growing at double, or in the case of admin, nearly 4 times the rate of your sales,
Yeah.
you've got a control problem.
Let's focus on that 18% admin jump for a second. That's not a small number. We have to ask the why here. Is this a sticky cost, like they hired a bunch of new expensive executives?
Because if it is, that's a salary bill they have to carry for years to come. That makes reversing this trend incredibly difficult.
Or is it a one-off? Maybe a big IT system upgrade or a consulting fee for some restructuring project.
If that 18% is from structural sticky costs, then this operational decline is going to be much harder to fix in the second half. If it's a one-off, management can argue it's temporary. But either way, it's a huge drag on that already damaged gross profit.
And the consequence of all this, the margin squeeze plus the bloated costs, is a brutal hit to the operating profit.
After all that, the operating profit, the result of just running the core aluminum business, fell sharply. It was down 12.3% to $211.5 million.
That 12.3% decline. That is the truest reflection of how this company performed in the first half. It's the number before any, financial wizardry comes into play.
And the operating margin confirms it. It shrank from 14.4% down to just 12%. That 2 percentage point drop shows you the combined crippling effect of weak pricing and cost overruns.
Okay, so let's put it all together. We have a company whose core operational engine just suffered a 12.3% contraction. So how on earth did the headline net profit end up flat?
Well, this brings us to what saved the headline number. We're calling it the finance lifeline.
The non-operational buffer that bailed them out.
And the buffer was immense. Net finance income, so money they made not from selling aluminum, but from managing their cash. It tripled.
Tripled.
Shot up to 16.8 million rupees.
So they made 3 times as much from interest income as they did last year. That is a very powerful non-operational shield.
It is. Think about it. LALU's core business declined by 12.3%. But because domestic interest rates are so high, their Treasury Department basically generated enough extra income to paper over most of that operational decline.
It's what turned what should have been a very ugly drop in headline profit into that stable, boring 140 million rupee result.
Exactly.
But this is where we have to be skeptical analysts, right? We can't just dismiss this as non-operational. Could this finance income actually be a strategic signal?
How so?
Well, is management just passively collecting interest? Or are they actively choosing to hold cash instead of reinvesting it because they see too much risk or not enough opportunity in the market right now?
That's a fantastic insight. If they're holding cash because they genuinely can't find good capital projects with a high enough return, then that finance income is a signal of extreme caution. It's a defensive move.
But even so, we can't ignore the core problem here.
No, it's fundamentally unsustainable.
You cannot rely on high interest rates forever to mask a double-digit decline in your core operating profit. The moment rates soften, that 16.8 million lifeline shrinks.
And that 12.3% operational drop will hit the bottom line with a vengeance. The true P&L, that $211 million in operating profit, that's what really matters.
This analysis of the operational pressure brings us perfectly back to where we started. Section 2, the ultimate judge of LALU's performance, cash is king.
Right. We've established the operational weakness, but now we have to face that huge gap between the accounting profit and the hard reality of cash in the bank.
The accounting versus reality gap.
And the gap couldn't be wider. You have $160.5 million in net profit on one side, and on the other, you have negative $8.9 million in operating cash flow. Profit is theory. Cash is fact.
And that negative 5.5% cash conversion ratio tells us that every single thing LALU did for 6 months, buying raw materials, manufacturing, selling all of it, in the end, destroyed cash.
It burned through 8.9 million rupees of cash flow.
So when we see this kind of massive divergence, our eyes have to snap straight to one place on the cash flow statement.
The working capital section.
Why didn't that profit end up in the bank, the main culprit, the working capital sinkhole?
Indeed. LALU consumed a massive 145.8 million rupees just to fund its day-to-day operating cycle.
All that cash just vanished into the machine.
It did. And it happened because they aggressively built up their current assets, inventory, and receivables way faster than they built up their current liabilities, like what they owe their own suppliers.
Okay, let's break down that 135 million. Where was the biggest drain?
By far, the inventory surge.
That's it.
133.9 million rupees was tied up specifically in building more inventory. That is a substantial number. Overall, their inventory surged by 12.5%.
And the total value is now?
It's a staggering 1.2 billion rupees, over 1,200 million. That is cash, sitting in a warehouse in the physical form of aluminum parts.
And it wasn't just inventory, was it? We also saw a big jump in what their customers owe them.
That's the 1-2 punch. Another 56.7 million was tied up in trade receivables. This means either customers are taking longer to pay, or LALU is offering them looser credit terms just to make a sale.
So more stuff in the warehouse and waiting longer to get paid for the stuff they actually sold.
Exactly. And both of those things suck up cash.
These are classic signs of inefficiency, or potentially something worse, a real slowdown in demand.
Which brings us to the critical debate for any investor looking at this. Is this inventory buildup a smart strategic move, or is it a massive red flag?
The source material gave us the key metric to analyze this: inventory days.
The inventory cycle now stands at 151.6 days.
152 days. That's 5 months. 5 months worth of capital is tied up as physical stock.
We have to contextualize that. If a company like this normally runs on, say, a 100-day cycle, then jumping by 50 days is a sign of profound trouble. It suggests sales have just fallen off a cliff compared to their production plans.
Okay, but let's argue the strategic case first. The bull case.
The bull case is that management is smart. They see supply chain problems coming, or maybe they saw a dip in aluminum commodity prices and bought a huge amount cheap. They're deliberately locking cash into the operating cycle now to get a big benefit later.
If that's true, this cash burn is actually an investment.
Correct.
The bear case, though, the red flag interpretation, that's much more frightening.
The bear case is that this buildup was completely involuntary. They made all this product expecting to sell it, but the demand wasn't there. That 5% revenue growth was a huge disappointment, and now they are stuck holding the bag.
A 1.2 billion rupee bag.
And if that aluminum is for specific projects that got delayed or canceled, you're now looking at a massive obsolescence risk. They might have to scrap it or sell it at a huge discount.
Which would then hit the gross margin.
Which, as we know, is already under severe pressure at just 22%.
This is why we have to stress this. You have to watch Q3 closely. If that inventory doesn't start moving, and moving fast, in the second half of the year, that 1.2 billion rupee asset could become a catastrophic liability.
The next earnings report is basically a referendum on management's inventory strategy. We'll find out if they were geniuses or if they were just stuck.
Now, besides that huge working capital burn, there was another massive cash drain that made the final OCF number look so bad. The tax anomaly.
Yes, this is crucial for interpreting that final negative number correctly. The company paid out 140.7 million rupees in tax during the period.
Which is a huge amount.
It's enormous.
Yeah.
Remember, the total OCF was only negative 8.9 million. The tax payment alone was almost 16 times bigger than the entire operating cash deficit.
And the key point here is that this 140 million they paid was nearly double the actual tax expense they recorded on the P&L for the period.
This is the difference between a current cost and settling an old bill. The analogy we use is a credit card. Your normal tax expense is like your current monthly bill. It's the cost of doing business today.
But what LALU did here, because they have that strong balance sheet, is they decided to also pay off a huge overdue bill from last year.
They essentially paid off 2 or 3 months worth of bills all at once.
And that lump sum payment, that 140 million, it hits your bank account, your cash flow, very hard, even though it's not a reflection of your current monthly spending.
Precisely. So if we mentally adjust for that big, non-recurring prior year settlement, LALU's true operational cash flow for the period was still weak because of the working capital, but it was much better than the reported negative 8.9 million.
So the working capital drain is a sign of operational sickness, the engine is broken, the tax payment is more of an accounting event, a strong company cleaning up its books.
That's the perfect distinction. Both hurt the cash flow number, but only the working capital problem is a predictor of future operational weakness.
And when you combine those drains, the sick operations and the big cleanup, you get a devastating free cash flow reversal.
Free cash flow is what's left after you've paid for everything, including new investments in the business or CapEx. LALU spent about 45 million on CapEx.
So after that,
Their free cash flow was negative 54 million rupees.
negative 54 million. That is a shocking swing from the previous year.
Shocking is the right word. In the first half of 2024, LALU generated a free cash flow surplus of 95.3 million.
So they went from a surplus of almost 100 million to a deficit of over 50 million.
That highlights the gravity of the situation. It means LALU cannot fund its investments, its working capital, or its dividends from the cash generated by its own operations. They have to dip into their savings.
And that reliance on savings brings us perfectly to Section 3, which is LALU's saving grace, the balance sheet. This is a company navigating chaos from a position of immense strength.
We're calling it the fortress.
Because it really is. If you only looked at the balance sheet, you'd think this company is indestructible in the short term. The liquidity ratios they're off the charts.
The current ratio, which measures their ability to cover short-term debts, stands at 5.21. It's actually up from last year.
A current ratio of 2 is considered healthy. 5.2 means they could pay off all their short-term bills 5 times over with their current assets. It's fortress level.
The quick ratio, which is a stricter test because it excludes that massive inventory pile, did dip a little bit. It went to 2.33 from 2.52.
And that dip is a direct result of that inventory buildup we've been talking about.
But even after you take the 1.2 billion rupee elephant out of the room, their most liquid assets, cash and receivables, still cover their current liabilities more than twice over. It's incredibly safe.
And crucially, the company has more cash than debt. It's in a net cash position.
The debt is minimal, just 54.6 million. Against that, they are holding 277.5 million in hard cash.
They have 5 times more cash than debt. It's an incredibly conservative and safe financial position.
And their leverage confirms that. Debt to equity is just 30%. This is a company that could easily take on debt to fund growth if it wanted to, but they just choose not to.
We also saw the book value, the net asset value per share, continue to climb slowly from about 42.60 to 43.18.
So on paper, the value is still growing because of that flat profit.
So we have this paradox within a paradox, a financially bulletproof company that is operationally struggling. But now we have to connect that strength back to the weakness.
The strength that funds the weakness.
And the clearest example of this is the dividend payment.
This is the moment of truth for shareholders. LALU paid out 84.3 million rupees in dividends in the first half.
And we've just established 2 facts. Operating cash flow was negative, and free cash flow was negative 54 million.
So that 84 million dividend could only have come from one place.
Their bank account.
It was funded entirely from their existing robust cash reserves, that 277 million cash hoard. And this requires a mandatory analyst warning.
Which is?
Paying out 84 million in dividends while your operations are burning cash is only possible because the balance sheet is so strong. They can afford to sell a few bricks from the fortress wall.
But the word we have to use here is unsustainable.
It is fundamentally unsustainable long-term unless the operations improve dramatically. This is not a distribution of current profits. It's a drawdown of past strength.
Management is using the balance sheet to project confidence, betting this operational slump is temporary.
But if these problems persist into the second half of the year, that dividend is going to come under existential threat. You can't pay it forever if you're not generating cash.
And this all comes back to the biggest hidden liability on that strong balance sheet. It's that inventory number again.
The 1.2 billion rupees. It makes the current ratio look great, but it represents the biggest constraint on their strategic options. That is 1.2 billion of highly illiquid cash.
The company is essentially using its fortress to absorb its own inefficiency.
A well-capitalized company can get away with being inefficient for a long time, but eventually the market demands results.
Okay, this has been a masterclass in reading between the lines. Let's move to our final section and crystallize all this into 3 actionable lessons for any investor looking at a company like this.
Let's start with the most obvious one. Recap lesson number 1. Cash is not profit.
The flat net profit of 140 million was a complete mask. It hid the reality.
The reality that the company generated paper profit but burned operating cash. The negative 8.9 million OCF and that negative 5.5% cash conversion ratio tell the true story. You cannot stop at the EPS number. You have to check the cash.
If you only look at the P&L, you miss the fact that the business can't actually fund itself. It can't pay for new equipment or even its dividends from its core activities.
It forces you to change the conversation from how much are they growing to how can they fix this broken cycle.
Which brings us directly to lesson 2. The single most important thing to look for over the next 6 months.
The Q3 watch item. The whole debate strategic build or red flag, it all comes down to that 152-day inventory cycle.
That 5-month holding period is the whole story right now. An investor has to watch the next report for 2 things.
First, a rapid and significant drop in that 1.2 billion inventory balance. And second, a corresponding surge in operating cash flow as they finally turn that metal into money.
Because if sales don't accelerate significantly in the second half, it proves that they have massively overproduced.
And that guarantees future pain, either through big write-offs or heavy discounting just to get rid of the stuff, both of which would crush their already weak margins.
It's all about the inventory. And that brings us to lesson 3, which is about the most visible consequence of all this weakness.
Sustainable returns. Specifically, the dividend.
That 84 million dividend payment should be seen as a signal of confidence from management, but one that was paid for with savings, not earnings.
And paying dividends out of negative free cash flow and negative operating cash flow cannot continue. The clock is ticking.
The operational repairs they need are clear then.
They're immediate and they're twofold. First, they have to get their costs under control and recover those margins, get that 22% number back up. Second, they need radical efficiency in working capital, get that 152-day inventory cycle back down to 100 or even lower.
Without those 2 fixes, that fortress balance sheet is just being slowly consumed to maintain the illusion of shareholder returns.
A perfect summary.
So this deep dive really shows the powerful difference between accounting stability and real economic decay. LALU is financially robust, yes, but it's using its past strength, its cash reserves, and high finance income to mask a severe operational contraction.
That flat headline profit is a manufactured number. It's a textbook case of a strong, older company struggling with modern efficiency in a tough market.
So we'll leave you, the serious investor, with one final provocative thought to take away from this. It links all these risks together. We've established that gross margin is currently a fragile at 22.2%.
Okay.
So the question for you to model out is this. If, in the second half, LALU is forced to take a write-down on just 10% of that massive 1.2 billion rupee inventory balance, say a loss of 120 million, what would that do to their already precarious operating profit, and where would that leave the gross margin for the full year?
That risk, sitting right there disguised as an asset on the balance sheet, is the single most potent threat to this company's profitability in the next 6 months. It's where past inefficiency is about to meet future reality.
Absolutely. The inventory balance is the ultimate watch item. That's all for this true P&L deep dive. We hope this has provided the necessary insight to look beyond the superficial headlines.